Welcome to this explainer. Look, if you've just been casually scanning the financial headlines lately, you might have completely missed a massive tectonic shift happening right under the surface in the global silver market. We're talking central banks making moves, physical vaults draining, and structural forces lining up in ways we honestly haven't seen in decades. So let's jump right into the data and see exactly what the smartest money in the room is quietly doing right now.
All right, let's kick things off with a pretty staggering number, $14. That represents a massive price surge in a window of just 14 trading days. And, this wasn't one of those slow, predictable grinds higher. Nah, this was a vertical repricing that caught even the most seasoned traders and veteran analysts completely flat-footed. The metal just blew right through price ceilings that a lot of folks were convinced were locked in for the rest of the decade. But to really grasp why this $14 leap is such a big deal, we need to unpack exactly how it went down.
Section 1. The Sudden Silver Breakout.
So, to see why this isn't just some flash-in-the-pan meme stock situation or a quick short squeeze, take a look at this incredibly condensed timeline. Back at the end of April, silver was just sitting quietly, going sideways at around $71, basically invisible to the average retail investor. But then, the chart just cracked wide open. Within 10 days, it broke 73. Give it another week, boom, past 80. By mid-May, we were printing prices in the mid-80s. When you see a timeline compressed like this, history tells us pretty clearly, this isn't random speculation. This is a deliberate, structural move by buyers with seriously deep pockets.
Moving on to Section 2, decoupling from gold.
Now, for literally generations, traders have leaned on one golden rule. Pun intended, gold is the big brother. When gold leads, silver tags along. But the source analysis here points out a fascinating divergence. Over these recent sessions, gold, which has a very tight, stable supply, traded completely flat. It even dipped into the red a bit. But in that exact same window, silver climbed $2 to $3. Sure, they might sit on the same shelf at your local coin shop, but right now, they are completely different animals. And that's because silver is being driven by an actual, measurable physical deficit.
Which naturally brings us to a huge question. Why is silver suddenly defying gravity all on its own? Well, the analysis points to a specific tipping point. See, the moment paper markets can no longer mask physical deficits, the price is forced to tell the real story. That historical relationship broke because the physical supply literally just isn't there to back up the paper contracts anymore. So we've got to ask, what exactly is vacuuming all this metal out of the system so aggressively?
That brings us to Section 3. The East accumulates.
To track down our missing silver, we need to shift our focus across the globe to the Shanghai Gold Exchange. Just look at this number, 16%. While Western traders are busy staring at red candles on their screens, Chinese buyers are happily paying a massive 16% premium over the Western paper price just to get their hands on real, tangible metal. During this specific window, physical silver in Shanghai was pushing $100 an ounce, while the U.S. spot price was lagging down in the low 80s. A premium that massive? That is a blaring siren telling us the official paper price and the real-world physical price have violently disconnected. And this exact disconnect is perfectly summed up by the concept of backwardation. As a quick refresher, backwardation is when buyers are willing to pay more for a commodity today than for a delivery in the future. The Shanghai futures market is sitting in backwardation right now, and textbook economics tells us this is a giant flashing neon sign. It means a physical shortage isn't some distant problem for tomorrow. It is happening right here, right now.
To really wrap our heads around the sheer scale of this shortage, check out this staggering figure. The source data shows China imported 836 tons of silver in just a single recent month. That is roughly 27 million ounces of physical metal swallowed up in just 30 days. That's not just a high number. It's actually a 17-year record high. And the most important takeaway here? This metal isn't being flipped for a quick profit or traded back to the West. It's being permanently locked away into solar panel production, electronics, and state reserves. It's gone.
And we can clearly see the four major demand engines firing all at once into a rapidly shrinking pool of metal. First up, China is absorbing historic volumes for industry. Second, Russia is officially adding silver to its sovereign national reserves, which is a massive historical shift. Third, we've got whispers from the Gulf region that sovereign wealth funds are quietly building up their own positions. And fourth, India is continuing its absolutely massive cultural accumulation. Look, when sovereign superpowers and giant industries decide a metal is critical, they don't hold a press conference, they just quietly buy it all up.
All right,
Section 4, Technicals and Western Shifts.
So with the East scooping up metal at a record pace, we have to flip the coin and look at the global macro picture. The divergence here is crazy. While Eastern vaults are quietly stuffing themselves to the brim with physical metal, Western COMEX inventories have been bleeding out, dropping all the way back down to pre-tariff levels. Container by container, the physical stuff has just moved east. What this means is the pricing power of silver isn't being dictated purely by speculation desks in Manhattan anymore. It's being driven by rock-solid physical demand in Shanghai, Mumbai, and Moscow.
But it looks like the West is finally starting to wake up. The analysis highlights a very recent shift. Western Exchange-Traded Funds, or ETFs, just saw 3 back-to-back sessions of net additions. Now, for months, these funds were just hemorrhaging holdings, but that relentless selling pressure has suddenly snapped. The crazy thing is, the silver market doesn't even necessarily need a massive flood of new buyers to keep pushing higher. It literally just needs the existing holders to stop selling. This reversal leaves enormous room for Western investors to pull up a chair and return to the table.
Building on that momentum, analysts are sketching out a pretty clear technical roadmap here. Initial resistance is sitting right around that $88 to $90 mark. Now, if the price punches cleanly through that level with solid volume, classical chart structure kicks the door wide open to 115. But here's the truly wild part. Veteran chartists are plotting long-term technical maps that point as high as $300 to $500 an ounce. Like the source material points out, it's honestly no longer a question of the destination, it's just a matter of timing.
So, we've looked at the market clues, we see the vaults draining, and we know the technical targets. But we've got to dig a little deeper. What is the actual macroeconomic motive driving this global shift? Why are sovereign nations and central banks suddenly obsessing over a metal they've practically ignored for a century? Which leads us to Section 5, the macro debt trap.
To get to the bottom of this accumulation, we have to pull back and look at the foundational macro picture, specifically a highly restrictive economic setup. Both consumer and producer prices keep coming in hotter than expected. On top of that, incoming Federal Reserve Chair Kevin Walsh has historically thrown around the phrase regime change when talking about monetary policy. The broader market is finally realizing that the old era, where the Fed could just casually swat down precious metal prices by jacking up interest rates, that era is quietly coming to an end.
Basically, the Fed is structurally boxed in by totally impossible math. Think back to 1980. Fed Chair Paul Volcker could effectively crush inflation by hiking interest rates all the way up to 15%. And he could pull that off because the total U.S. national debt was hovering around $1 trillion. Today, we're closing in on $40 trillion. If you tried slapping a 15% interest rate on $40 trillion, you're looking at an annual interest expense of $6 trillion. That is mathematically impossible to sustain. The harsh reality we have to face is that the aggressive hammer Volcker used to save the dollar has been physically removed from the toolbox.
And because those old monetary tools are completely broken, people aren't just sitting around waiting. They're taking matters into their own hands. The source material highlights something really interesting. State legislatures, places like Alaska, Texas, Florida, and Kansas, are actively passing legislation right now to recognize gold and silver as official legal tender. We are literally witnessing a quiet state-by-state constitutional restoration of metals as money, all happening right under the radar while the broader public is mostly distracted. Which brings us to our conclusion for this explainer. The source wraps up with a highly provocative thought. The structural forces driving this massive realignment, the glaring deficits, the aggressive Eastern accumulation, the absolutely impossible debt math, they aren't hiding anymore. The clues are right there in the data. The smart money and the sovereign wealth funds, they've already placed their bets. So the real question you have to ask yourself is this. Will the average retail investor spot these massive structural clues today, or are they going to wait until the next major leg up makes today's prices look like an absolute steal? Thanks for hanging out with me to explore this. I hope it helped untangle some of the deeper forces at play in these markets.
Disclaimer, this video for educational purposes only and
Keep
not
your eyes on the
financial
data,
advice.
and I'll see you
Always
next time.